Today is the 29th of August, 2010. Welcome to today's Silver Log. All of the images, charts that I use within this video are available for download on the blog, the silverlog.blogspot.com. And we're going to look at the technical analysis, and we had this trend line. It broke. The symmetric triangle that we were in was pretty nice in the sense that what we see with this particular chart, after we had this original or this last previous significant rally, that we had a volatile time correction, and we followed that up with an unvolatile time correction. So we've had relative to time corrections from this significant rally. So therefore, it's been in a time correction for quite some time. But as there's no such thing as up too much or down too much, there really isn't there's no such thing as it's corrected through time for too long. If it's correcting through time right now, then that is its path of least resistance. And it really needs to break out above 19 3/4 to consider it that it's moving towards a bullish trend. So on the shorter term time frame, the confirmation we want to see is within we'd like to see a higher high. That would be nice to see, although it's not important. A significant higher low is. And the 2/3, like 18 and change, that would be significant. If it has a big candle afterwards, sort of like a this move towards this move, that really seems to be the only one we have, then that would give us an area for concern. But just like I'm saying, now we're still in this range. If we go down another dollar, we would still be within the range. On this chart, we can also make a significant case that we're in an inverted head and shoulders pattern. And likely targets for these are bullish. The resistance level would be about 19 and 2/3, 1960, 70. And the bottom of this level is 15-ish or so, which could give us a price objective to about 24. And Fibonacci has some big levels around that area too. So that's a significant level. Obviously, along the way, you're going to have resistance that's going to meet the. Right now, we're at an area where we've had some significant resistance before, and we can see that right around 20 area should be significant. And then when you get up to the 21.5-ish or so highs, 21.10 to 21.35 would probably be pretty significant. And those were trends at those different levels along the way. But when you're looking at these charts, we can see previously you want to see how the corrections work. When you're reading the charts, I want to start with the summer of 09. Big, nice move. And that's what you want to see. When you have a big move, what kind of confirmation? This was nice confirmation. The candle that preceded it had a bullish reverse cattail right towards, that candle there, and we had a nice move higher, a volatile time correction, but it held the Fibonacci well from this high towards this low. That does look about 2/3 retracement. And it followed up with a nice move higher, and its move is from 14 to 15, so that's about 7-6%, same as this. And it had a huge move, and then two moves higher after that. So you can have bullish moves from these breakouts, and the move from here to here is 14.5 up to about almost 18, and that's well over 3, which would be about 20+%, and 20+% on 19, that would get us to the 23 area. And well, this was a matter of 3 weeks. It had a nice time correction, and after that move bring another big candle, but it had 2 time corrections. Now, at this point, there was no confirmation, but there was no confirmation saying, hey, we're definitely going to go lower. And you have the big move lower, which brings us to this area. You really wanted to see support here, but that never happened. But that's why you have the areas where I like to see support here. So we compare that to now. We want to see support maybe around here on the long side, but you really want to hold the bottom of this range, which is the more important level. And So it had the move lower, which followed up with a nice move higher. It had a nice time consolidation, higher high, uh, higher low, and it might have even had a higher close too. It's just the gap higher was pretty big on the Monday. Followed a nice move higher with two interesting little candles. An indecisive candle, this one tells me, but obviously it was a time correction within this move higher. There's a reverse candle right here, and look what follows: a big move lower, time consolidation, with a big move that ended up being a trap. And the trap was this move in towards here. Oftentimes from failed moves come fast moves, and this was a fast move, which is the head, or the head for the inverted head and shoulders pattern. And because failed moves can create fast moves, we can see that this little move, I'll change the color, I'm annoyed with the red too. This little move towards here is a failed move, and it followed with a fast move. Now on the spreadsheet program that I use, I have no idea how to use moving averages. I wish I knew, but I don't. So I'm going to follow it up very soon with a line chart of the moving averages. And when you look at these charts, if you're looking at a very few candles like this, generally speaking, I like the lower number ones, the 10, the 40, or really the 42. I'll mention that when I show the charts. And even the 100 would be one. But obviously it depends on what's active. If the 200 or 300 is very relevant, then I'll put that on there when it's coming near. Say, for example, it's been going lower, and say it's been going, well, that doesn't look like that. But just say it's coming down towards this area, and it's key resistance, and I want to have it. But when you have more candles, say hundreds, then the 10 and the 20 and the 40, it really doesn't work too well. Maybe the 40 is your lowest. I like the 50, 100, 200 when you're looking at more of those more candles. And if you're looking at like 20 candles, then you can go with the 5, the 10, 20. And yeah, so that's that. What we're going to do now is go to the line chart. And here it is, a line chart. The green line represents its high for the week, the red line, the lows. And the 10-period moving average, 10-week moving average, it was trading within the range ever since it got in towards that area right in here. As before, it was trying to find a level of support. And previously, it was resistance, and here you can see it was support. And they're lagging, and they're telling you, hey, right now we're in the area of support as a range. Now the 42-week, and I'm using 42 because it represents the 200-day moving average the best on the weekly chart. That's because 41.1 week represents around 200 trading days when you count in holidays. So some are higher than others. December, the New Year's, that's where it would be a lot different than other years. However, that general area has been support once, twice, 3 times. The more times support has been tested, the more likely it will to be broken. And we're here now. So it did find support there. However, if we come back down to that level very soon without having a nice breakout, it would be a 4th test. And these are the next moving averages, the 100 and 200 week moving averages. And there will be areas before then. And that's obviously on a downward move if that were to occur, just because silver has very good fundamentals based on its metal that it has for uses, its supply, and the fiat currency, which is really getting annihilated overall, especially when you price it in different metals. You can't go by the US index because other currencies are losing against gold and silver. That's really the biggest tracker of them all. Now we have the weekly chart with more candles and or more days going back to 2001. And I've talked a lot about this long-term chart. I've mentioned on several occasions the Fibonacci from this high and this low, which is this. The next one is, or the one that we're moving towards next, is in here. That's the 21 and change resistance that was found in 2008. We're looking for our second test, or our first test since the established level. It's been a while. So you would think that there's a decent chance that you can find a level of resistance. For if you do, and then you come back towards this area in here, that would still remain bullish. And it's expected to find resistance, doesn't mean you will. For it didn't find much support on the key areas on the way down. And that's when mass movements, mass aggression can happen either towards the downside or towards the upside. And when you have Fibonacci levels or any major support resistance that gives in and breaks where you should find it like big time, then expect the big move to continue. When we've established this Fibonacci, it broke through this Fibonacci level. And look at this fast move up towards, well, the next Fibonacci level was in here and then in here. The next one after is 32. And that's why if you see any moves where, say, we get to 32 and it just keeps going higher to 38, 39, well, it's going to 50, which I would expect to be huge resistance given that was the highs of 1980. As far as the trend line is concerned, we can see we've had multiple tests of this. So if it is a failed move, then most likely it's going to be pretty big and find maybe some support down towards this area in here, and that's if it's a failed move. As far as some of the moving averages are concerned, I have the 10-week moving average, and well, it's really cluttered. You don't really need this moving average here to tell you, hey, we're in a bear market, and we're below the 10-period average. You should know that just by the observation of the chart. That's why in a candlestick chart, if you have a lot of candles, you don't want the 40, or maybe the 40, but you don't want the 10 or the 5 or the 20. You want the bigger ones, like the 100, 200, and normally 50, but I got 42 just because it works out to the 200-day moving average. And the 42 period is very significant. And that is because the 200-day moving average support, and it was showing indecision in 2003, but still being support because it crossed back and forth between those moving average. It had its liftoff period towards here where it found successful sell-off after this big move lower. And its support was successful on many occasions here and the big move higher. So when you first came to this level, it found support, found support, found support. And then it went below it. We can see how it was used as resistance there. And oftentimes when you have a failed move, which is what this was, it found support at the 100 period, creates a fast move. And there is the fast move that followed right in here. We developed this range, and when we came below it, we never really found much support here at the 42-week moving average. Nor did we find support at the 100-week. Nor did we find much support at the 200. We found a little at the 200, but not much. But on the way back, as far as the 42-period moving average is concerned, it was resistance here, and support, and support. So that's very, very strong as it has been held as support. And it's been testing it long enough where it's ready for a breakout, meaning we're in this time consolidation. There's no such thing as consolidating for too much time. And if it does, you'll see the moving average cross back and forth. The 100-week moving average support, lifted off, support, support, gives in, resistance, and it pierced above it, went below it, and then found support there again. So if we have any more big moves lower, then this pretty much 2-year moving average will be a significant level of support. And because we had so many moves lower, that's why it's still only a little above 15 or so within this chart. The final chart we will look at is the SLV ETF chart from July the 21st to current. And the reason why I'm using SLV is because it's the only index that I can find that can trade within the intraday time frame. As the silver COMEX, I am not able to get stats on the 5, 20, 30, whatever minute time frame. This is 15 minutes. However, the trend line that brought us higher, this was the one that got broke or taken down. The moving averages on the screen. We'll start with the first one, the orange one. That is the volume weighted average from this point in here. Support, broke through it. So it wasn't that well of support resistance. It acted as support in here. We've seen this bear trap. This bear trap brought some consolidation, followed by the fast move higher. And the consolidation was right on the VWAP. Then it came below, another failed move below it, which created its fast move higher, and an extremely fast move towards the upside. The green one, it's the 5-day moving average. And I've been stating that a lot of times when it was coming down as resistance, it really didn't it went by it pretty good. And this is only a couple months. However, the support level didn't hold for that long. Resistance, then it got taken out below it. And then the second time, it's a few times in the last few months, it has taken the 5-day moving average out pretty well when it's declining. And the same thing when it's positive. But now we are well extended from the 5-day moving average. More extended than we were back in this area and here. And it's an area you'd like to find a support. And all these little lines are support areas. And the next one is the blue one, which was the VWAP from this particular high, which we have this failed move above it. And what happens? Fast move that follows, which was resistance in here, got above this area here. So you try to find support, boom. It doesn't do it, and it has a significant move lower. And on the way back higher, it got above it really nicely this last week, getting above that VWAP. So now we can see how it was starting to flatten out. Now it's rising because we are having these significant gains. And the next moving average is the VWAP from this low, which was founded as support in this area here. That's going to be an area that I would expect support to be found at that VWAP. You also have the Fibonacci from these lows and the new highs. And if you make new highs, then you adjust the Fibonacci higher. And what I notice a lot of times is it's always a coincidence that Fibonacci works out to a significant high. Meaning if this was an area where it were to top out, then we see how, oh, it's a coincidence that it's support there. And I think what you can do is you can say, hey, that might be an area where we top out because the 1/3 retracement is at that key resistance. And that can be the case. However, if it continues higher, then you'll notice the VWAPs go higher. So this will go up to here, and then this would go up to here. And as it goes higher, what I'd be looking for now is for this Fibonacci, the 1/3 retracement, to come up towards here, and maybe the 2/3 up towards this line in here. That's what I would be looking for. So just because this first third is here doesn't mean it will top out if you use any type of technique like that, but it means that it very easily can, because quite often Fibonacci levels do match with significant support and significant resistance. And on the very short term, you have this trend line. If you break this trend line, then the VWAP would be the next area you would likely encounter a level of support. Thank you for watching this weekend's video, and have yourself a great weekend. Bye-bye.